So moving into number two, and you kind of briefly touched on this in number one, what is the difference between a redundant asset and an operational asset?
Yeah, and so that's quite common in business valuation. So a redundant asset, it's like the name implies, it's an asset that's not required in the day-to-day operations of the company. So, you can think of the very obvious ones, in extreme cases, like I mentioned, a ski boat.
Right.
And I say it's extreme, but I have seen situations where people have done that, where they own assets such as a ski boat within their company on the basis that, hey, there is that small maybe promotional aspect, but in reality it's not required in the business, and so that would be removed as a redundant asset in our analysis to clean up kind of the balance sheets in terms of what would a buyer actually buy, because at the end of the day they're not going to be interested in buying those assets. And it can also be assets that are less straightforward, such as excess cash.
Sure.
Maybe this company has built up a large cash reserve and it's just holding it in the company. There's nothing wrong with that. It's, you don't want to incur that tax liability by dividending it out to the shareholders. You just leave it there and defer it until needed.
Mhm.
And so, in our analysis, that might be something that we might consider redundant, as well as things like investments or even, a shareholder debit balance. Maybe the company owes the shareholder money,
Right.
or there's related party loans, things that,
Mhm.
if you want to think about it, if the business is not in the business of doing, like if the business is not in the business of lending people money,
Right.
then therefore that would be considered redundant. Um, and when we're doing an analysis, I think one thing to keep in mind, especially around things like cash, is what are the company's liquidity ratios? How does its current asset ratio look like? What does its debt to equity ratio look like? And how does that compare to the industry? Or does it have existing debt facilities in place that, say, hey, these are covenants, you can't exceed X for your current ratio or Y for your debt to equity. And if by removing that cash on a notional basis,
Mhm.
it breaches those covenants, well, that's an indication that cash is not redundant and it's
Right.
required in the business. So we'll look at things like that as well, to determine, how much, for example, cash is redundant, or how much can potentially be removed without putting that business in a bad spot.
Right. I think that's an interesting point. I don't think I've ever looked at it that way because I know we get a lot of clients, they get into that, point in time in, the business life cycle. It's been around for a number of years. They've accumulated a bunch of cash. Maybe just looking at the balance sheet in general, you say, well, you got a pile of cash here, but maybe looking into those ratios in more detail gives you a bit more insight as to what is actually the excess or the redundant portion of that cash. Because then I think it's probably twofold. You can, make some decisions as to what to do with the actual excess. And then it probably also helps you in maybe having that discussion, should CRA look at some of these things to say, well, we did some due diligence here and we said, they've got a couple $100,000 here. You might think it's excess, but based on, these working papers and these calculations, they need this money to operate. Otherwise, they're going to be in a cash crunch. So that's a good point, I think, on that side.
No, that's exactly it. And I mean, this might be a bit off topic, but we see that scenario, uh, or similar scenario, a lot in terms
Right.
of we do a lot of matrimonial work, and so when
Oh,
people
okay.
have a business, often when it comes to spousal support, one party will be looking at the balance sheet and they'll see a large net income number, and they want all that net income to be attributed for spousal support purposes. And not every time, but sometimes we have to, after we analyze it, we can see, hey, this company A, it can't distribute that net income. It needs to retain it because it has to service its debt. You
Right.
know, if it pulled it out, you'd be offside with your covenants, or it needs to reinvest it for capital assets and whatnot. And so it's just another way that we often see this issue brought up, because yeah, people sometimes get lost in terms of what bottom line net income is versus what is actually the reality of a company's cash flow situation.
Right. Yeah, and those two are very different. Just because you can net some dollars on the income statement doesn't necessarily mean that the company's healthy overall. You might be really struggling in the cash flow department. So, yeah, that's another interesting point because I think a lot of times, just like looking at that dollar value on the balance sheet, looking at that net income for, splitting out spousal support, that might not tell the whole story. There's a whole lot of cash flow items that are represented up in that balance sheet that need to be accounted for as opposed to just splitting out those monies for spousal support payments.